Hello, we are just getting started. Welcome to Be the Boss of Your Money. I'm your host. My name is Mitch Goldberg. It is such a joy to have you here today. Your time is very valuable, and I greatly appreciate that you chose to spend some of it with me. We are talking about the meme stocks. We've been talking about this a lot, meme stocks and crypto, but meme stocks absolutely got mauled today after a huge run the last few days, giving it back. We're also talking about the two other big pieces of news, even more significant, the biggest jump in inflation since 2008 and how the market just walked right by it. And the S&P 500 hit a new all-time record high today, first record since early May. So we've got a couple of big things to talk about. We're going to run a quick intro. We're going to take a deep dive. We're going to give you the perspective that you need, help you be the boss of your money, because that's what the show is all about. So here we go with the intro. We're back. Thank you so much for joining me. If you're just tuning in now, my name is Mitch Goldberg. This is my live stream. It's called Be the Boss of Your Money. It's all about sharing information, knowledge, lessons learned, how I've seen clients overcome challenges over the last 30 years to become better off financially. I share this with you so that you could be the boss of your money. It's an educational show about personal finance, investing, credit, etc. There's a lot that falls underneath those umbrellas. Today, the big news is the stock market hitting an all-time high. So I think we need a round of applause for the stock market. All right. So that is good news. And now we have some things to really get into. And let's talk about the meme stocks. I'm having fun with this. If you have any questions, let me know. Ask me in the comments below. Hit me up in the comments with your questions. If you're watching this in the replay, welcome to you as well. And, just ask away any questions you have as if you were watching this in the live stream. I will definitely see the questions and get back to you. It's my favorite part of doing this. We already have one comment in the hopper. It's, I think, going to be the label should be comment of the week. Hi, Daddy. Love you so much. You're amazing. Keep it up. That is my daughter, Jessie. Thank you so much. Jess Goldberg in the house. Thank you, sweetie. That is so dang darn cute. So, let's just take a look. Let's run down the big news today. We'll start with a quick screen share. Pop myself up in the corner here. All right. So this should be big enough for you to see on your smartphones. Okay. The Dow up a measly 19. It was up a lot more earlier today. So the Dow gave back its gains, was up at one point over 200 points on the day, gave it back pretty good. But the standout winner is the NASDAQ, back above 14,000. S&P 500, new record, new closing, all-time high. It's one thing to hit an intraday record, but it's a whole other thing to hit a closing high, which it did today, up 19 points, almost 20 points. Gold up a little bit, up 6 points. I'll tell you why that is significant, but the move is not that significant. Oil continues to trade around $70, and the 10-year Treasury, again, something very significant. It's at 1.43%. The yield is down. The move itself is not really that significant, but the direction is very significant. And the VIX down to 16.1. Look at that, 16.1. All right, let me highlight that. 16.1, down 10%. You see that? The VIX is down 10%. That's a pretty big move. Even for the VIX, 10% in a day is a big move. It's very common for the VIX, the volatility index, to move, 4, 5, or 6% in a day. This is a measure of fear. It's a measure that tells you institutional investors. It tells you that institutional investors are willing to pay more for protecting their portfolios, more for hedging. So when they start to worry, they pay up for hedges. But it's the VIX is coming down so much now. I wonder when we're going to start talking about complacency in the market. Okay, are we whistling past the graveyard? All right, let's take a look and see if we could pull up crypto. Okay, here's crypto. We'll take a look at the crypto market. There's a lot of news on crypto we're going to talk about, but basically, Bitcoin 35,900. Last I looked, it was up, but it's very volatile and it trades 24/7. Let's take a look at Litecoin down to 163. Let's take a look at Doge down to 32 cents. Continuously, it goes down. It started out as a joke. And by the way, there's a coin called, I thought it was a joke, called shitcoin. And I looked it up. It's actually a coin called shitcoin. There's a few other coins with weird names that are even worse than shitcoin, but that's about as far as I think I could go in the, in the live stream. Well, there is one, I'm going to skip it because now it's getting a little weird. Okay. But there's two big pieces of news today with crypto. Tell me what you think of this. Coinbase strikes a deal to let you add crypto to your 401k. Okay. It goes like this. Coinbase and 401k provider Forasol have teamed up to give certain companies the opportunity to include cryptocurrency investing as part of their retirement plan. What do you think of that? Putting crypto, into your 401k plan. Do you think that's a good idea? Bad idea? What do you think? I'd love to hear. I'd love to hear your opinion. I'm a very big believer in buyer beware. I don't like to tell people what they can and cannot do. Somebody wants to invest in crypto. They want to invest in a meme stock. I find it disturbing though when someone who's famous like Elon Musk puts out comments on Bitcoin or Dogecoin. People jump in there unsuspecting. They buy it. They take Elon Musk's word as gospel, and then they go into it, and then the cryptos get crushed, and people are like, "What the hell happened?" I think people have a responsibility to be careful of what they say over the airwaves. I know in my industry, us financial advisors are very heavily regulated in terms of what we could say. We have to be careful about hyperbole and recommendations and talking about things in an overly positive or negative way. And I think people who are influential should probably show the same standard of care. But I am a fiduciary, as my financial advisors are as well, my fellow financial advisors. So a couple of other things today. But crypto in a 401k plan, maybe crypto is the great thing that's going to happen. Maybe it's not. I mean, I know people made a big fuss about El Salvador, a teeny tiny little country with a teeny tiny little economy in a country where poverty is the norm. And I'm not just talking about poverty like poverty in the United States. This is like, people living in grass huts poverty. Okay. It's like really bad, but they're going to accept Bitcoin as legal tender, as currency. Okay. I don't think that really moves the needle. And is it a stunt? What's going on there? The president of El Salvador says that people who remittances, when people in the United States who are from El Salvador, for example, send money back to their relatives in El Salvador, when these poor people go to get that money, they have to pay sometimes up to a 10% fee to get their money, which is an outrageous fee. That's just highway robbery, but they get away with it in El Salvador. And supposedly the Bitcoin will, by accepting Bitcoin, that'll substantially reduce transfer fees. That's one of the things behind it. JP Morgan says there's weak Bitcoin demand. Okay. JP Morgan says weak Bitcoin demand from big investors, and that will keep it in a bear market. I thought that was pretty substantial. We've got a couple of other things to take a look at. I also want to let me close out those screens, get rid of the crypto. I want to take a look at the meme stocks. Let's just take a quick look at those, at the meme stocks. All right, and get to screen 4. Put myself back up here. Okay, here we are. So AMC, which was just $72, is now down to $42.81, down 13% today. These are pretty significant hits. Okay, these are definitely. Make sure my mic's there. Spot. These are definitely tough hits. GameStop, in spite of bringing on a respected, highly respected executive from Amazon to be its new CEO, the stock was still down over $80 a share, down, as you can see, 27%. Bed Bath & Beyond down 8%. Cost down 6%. Clover down 15%. Look at that. Clover was just in the 20s and people were so gung-ho about it. And Wendy's is down. I mean, of these companies, Wendy's, I think, is the real company with a decent business that is an ongoing concern. The others I find are questionable. But I want to just show you something that I'm looking at that I think is particularly important here. And James, I see you out there. I'm going to acknowledge that. I'm glad you're here. James is out there. Hey, Mitch, I haven't caught one of your lives for a while. Hey, man, I'm glad you're here. By the way, I watched your video, the one that you did from your backyard porch, the last one at your house where your babies were born. And I started to get a little teary-eyed, but good for you. I mean, if you moved to a new home and didn't have some heartstrings tugging at you from the old home, then something went wrong. It's a good thing that you have those feelings, because it means you lived very well there. You have so many good times to celebrate. So I'm very happy for you, James. It's itchy. The beauty of going live is you get an itch in your nose and you can't do anything about it. Well, you can, because this isn't TV. It's not cable. It's just my live stream show. All right. So anyway, AMC. I want to show you something. You see this lineup here? I'm going to make this a little bigger so we could really hone in on it. All right. You see this on the side here, AMC between $72 and $1 and change. The closer the triangle in the middle gets to the middle, the further it gets from its year high and approaches the middle between its high and low, the less I think these stocks are going to be embraced by investors. I say that because it means that the FOMO, the fear of missing out to get into them, goes into reverse, and then the FOMO to get out of them to preserve profits hits. And so many people got into AMC in the high 30s, 40s, 50s, and 60s. And now these people are in losses. Maybe they don't want to sell because they don't want to take the loss, but they definitely want to get back to even so that they can sell. And the people who still have profits are now thinking, I better sell now and protect my gains. GameStop down from 483 to 220. So that is below the halfway point. Bed Bath & Beyond is almost to the halfway point. Cost is, forget about it, way below the halfway point. Clover is just about, below the halfway point, but still, look at Wendy's. Wendy's is coming down too. And that's what happens to these stocks. So I want to show you guys something that I was talking about, and I'm not sure which one it is. Let's talk about meme stocks. Yeah. So one of the things, if you missed the show yesterday, we talked about were meme stocks and if there are any paradigms. So just check this out. Here's a clip from yesterday, which I think says it better yesterday than I could say it again today. As far as the meme stocks go, this is just 1999, 2000 all again. We saw a biotech speculative frenzy, a small oil company speculative frenzy. We see these from time to time. But ultimately, if fundamentals don't come around, investors start to sell. Like, look what's happening to Dogecoin and Bitcoin. When they do start to go down, it becomes a race to get out of them just as quickly, if not faster, than a race to get into these stocks. So you could diamond hands AMC, you could diamond hand Clover to the moon, but ultimately you're playing with fire. I would not be the one who tries to squeeze every penny out of these trades. These are not investments. These are stocks that you borrow, you play with them, and you get out of them. That's what I see. All right, I appreciate you taking a look at that. So I don't think the meme stocks are some new, paradigm of stock, of investing. Okay, let's take it now to the CPI. The market hit new highs today in spite of the CPI, and this is pretty significant. So let me go to the headline. Okay. So I'll show you what I'm looking at. Okay. Inflation hotter than expected, but it looks temporary and likely won't affect Fed policy. So let's talk about inflation for a minute. The inflation came from things like a gigantic rise in the price of cars, especially used cars. There's inflation everywhere. Some of the prices that you see high inflation have actually started to come down, like copper and lumber. But a lot of this has to do with being compared to prices a year ago at the peak of the economic shutdowns from the pandemic. And as those months roll off, we go, instead of going from, May to May, April to April, May to May, June to June, as we start to go from like September of 20 to September of 2021 comparisons, as the old months roll off, the rise in inflation not only moderates, but a lot of the bottlenecks, the supply disruption bottlenecks, start to become cured. And there's bottlenecks in everything, because when demand shut down, suppliers shut down production across the board of almost everything. And demand is coming back quicker than corporations are able to crank out supply again. But the supply will come. I personally am 100% confident of that, which is why I'm also in the camp of the jump in inflation we're seeing is temporary. But we got past the big bad number, we got past the big bugaboo of inflation. Okay. So we got past it. You saw the headline, big numbers, biggest since 2008. And I do expect we start to see a lot of this stuff moderate. Prices might not go back to where they were pre-pandemic, but some items will go lower in price. Some items will stay elevated in price, and some will go somewhere in between. I wish I could tell you exactly what those items are, but the point is, I don't think we're living in a new paradigm of inflation. If there's one thing that the global economy is really good at, it's finding new supply and bringing on manufacturing to everything very quick. We've got so much more automation, artificial intelligence, computers, CAD, you name it. This is not the 1970s redux. And part of the 1970s inflation was because of an oil embargo in 73 and 74. The United States economy had a lot of growing pains to get to the 80s. And one of the things, I know Federal Reserve Chairman Paul Volcker of the time gets credit for taming inflation. But, one thing that doesn't get enough credit is in 1980 was when mass adoption of the PC came about by companies. And I think that had a lot more to do with taming inflation than Paul Volcker jacking up interest rates and throwing the United States into a pretty bad recession in the very early 80s. All right. So that's what I think. That's my story. I'm going to stick with it. And let's see what else we have. Claims. Okay. So first time unemployment claims hit a pandemic low under 400,000, and continuing claims also dropped. So I still don't think we have too much to worry about, but this continues the Goldilocks theme, where we have decent economic growth, inflation, which is elevated now, looks to be temporary. People are really worried about wage inflation. That's the next big thing people are going to worry about. But we're not going to find that out until early July when we get the June figures and we see how wages worked out for this month. But again, as people get into work and the federal unemployment starts to run out and states stop paying that money out, I think you're going to start to see people get back to work. There's going to be more competition for jobs. And I think that will greatly moderate wage pressures for all businesses. And I think we've got some good things to look at. Now, what should the Fed do with its giant balance sheet of $8 trillion? Just to put it in perspective, before the Great Recession, the Fed's balance sheet was about $800 billion. And it got up to $4.5 trillion or so after the Great Recession. Then it started to get paid down to about $4 trillion, and now it's up to $8 trillion and growing, still growing pretty quickly. But what should we do? I think the Fed should taper sooner than later. I think investors will be upset, but I think the economy will be better off. And if you take care of the economy, investors will be taken care of after that. But don't take care of the stock market first and then try to take care of the economy. Take care of the economy first, and that'll take care of everything else. I'm a big believer in that, and I think the U.S. economy has more than enough escape velocity to wean itself off of Fed stimulus. So that's my story today. I greatly appreciate you taking the time to watch. I will be back on Tuesday. So quick programming note, I'll be back Tuesday. I have a function I need to be at on Monday evening, so I'll be there. It should be a great time. If we're not connected on LinkedIn, you can find me there, Mitchell Goldberg, okay, on LinkedIn. And I am on Instagram at InstaMitchG. You could catch me on YouTube and see all of my content in one convenient place, all my video content. It's YouTube. The name of my YouTube channel is Client First Strategy. And of course, you can always catch my follow page, my like page on Facebook, which is Client First Strategy. And on Twitter, I'm at Mitch_Goldberg. If we're not connected in those places, definitely find me in one of them. Let's connect. Let's talk. I love hearing from you. So if you have any questions for me or you want to talk about anything financial related, you know, I'd love to hear from you. That to me would be a lot of fun, and I'd appreciate that. So I'll see you Tuesday. Thank you very much.